Every time you look at a chart of the S&P 500 running circles around international stocks for the last decade, that advice to build a three-fund portfolio starts to feel less like wisdom and more like an expensive drag on your returns. And yet, every bogglehead, every CFP, and essentially every serious institutional investor will tell you that owning just one index fund is a concentrated bet, not a diversified portfolio. So who's right? Here's the short answer. The S&P 500 portfolio has historically paid more in raw dollars over long stretches, but historically is doing a lot of work in that sentence because over the one decade that matters most to a retiree, the S&P 500 lost money. A three-fund portfolio didn't. By the end of this video, you'll know exactly which approach fits your situation based on your age, your risk tolerance, and one question that the research shows most people will never actually ask themselves. This is educational content, not personalized financial advice. Let's get into it. Start with the actual numbers. Using long-run historical return assumptions, 10% annually for the S&P 500 and roughly 8.5% for a classic three-fund portfolio split of 60% US stocks, 20% international, and 20% bonds, here's what the dollar gap looks like. $10,000 invested as a lump sum for 30 years, $175,000 with the S&P 500, $116,000 with the three-fund portfolio. That's a $59,000 gap. $500 a month for 30 years, $1.135 million with the S&P 500, $827,000 with the three-fund portfolio. That's a $308,000 gap. $300,000. Not from one bad stock pick, not from a market crash, just from the drag of international stocks and bonds, pulling the average return down by about 1.5% per year. That number is real, and if you stop the video here, the S&P 500 wins. But there's an asterisk, a big one, and it's the thing that changes the entire answer depending on what you need with your money. First, let's make sure we're comparing the same things. The S&P 500 portfolio, typically one fund like VOO from Vanguard, VXAIX from Fidelity, owns 500 of the largest publicly traded companies in the United States. Apple, Microsoft, Amazon, Nvidia. That's it, one country, one asset class, about 500 companies. The three-fund portfolio is different in structure. It's built from three index funds, one covering the entire US stock market, which includes the S&P 500, and then one covering international stocks outside the US, and one covering US bonds. The Vanguard version uses VTI, VXUS, and BND. The Fidelity version uses different tickers, but the same idea. A classic split is 60% US stocks, 20% international, and 20% bonds, though those percentages shift with age and risk tolerance. Here's the thing most people miss about the cost difference. Both approaches are extremely cheap. VOO charges 0.03% per year. The three Vanguard index funds blended together cost roughly 0.04% to 0.05%. The annual difference on a $100,000 portfolio is about $20. The fee debate is basically over. These two strategy costs almost exactly the same. So the real debate comes down to three things: returns, volatility, and behavior, and they don't all point in the same direction. Let's go category by category. Returns. The edge, S&P 500. Over the last 30 years, the S&P 500 has delivered around 10% annualized. The three-fund portfolio, depending on the international and bond allocation, has come in closer to 7.5% to 8.5%. That gap is largely explained by two things: the bond drag and the long stretch of US outperformance since 2010, driven by American tech mega caps. If you had invested from 2010 to 2024, S&P 500 wins by a wide margin for stock. Volatility. The edge, the three-fund portfolio. The S&P 500 has a historical standard deviation of roughly 15% to 18% annually. The three-fund portfolio, with its bond component absorbing some of the swings, comes in at roughly 12 to 13%. That sounds like an abstract statistic until you translate it into dollars. On a $500,000 portfolio, a 15% swing is $75,000 up or down in a given year. On the three fund, it's closer to $60,000. For most people, the difference between watching $75,000 disappear and watching $60,000 disappear is significant. Worst drawdowns. The edge, three fund portfolio. This one is stark. In the worst crash of the last 50 years, the S&P 500 fell roughly 51%. The 3-fund portfolio, with its bond cushion, typically falls somewhere between 25% and 35% in the same kind of event. To put it plainly, if you had $1 million before the 2008 crash and you were 100% S&P 500, you had about $490,000 at the bottom. In the 3-fund portfolio, you had closer to $650,000. For a 35-year-old who doesn't need the money for 30 years, that drawdown doesn't matter that much. For a 63-year-old who's 2 years from retirement, it can change the rest of their financial life. Diversification. The edge, the 3-fund portfolio. The S&P 500 holds 500 companies. The 3-fund portfolio holds over 15,000 stocks globally, plus 10,000 bonds. More importantly, the top 10 companies in the S&P 500 now represent over 33% of the entire index. For every $10,000 you invest in VOO, over $3,000 goes directly into 10 companies. Almost all of them are large cap US tech. That's not diversification, that's a concentrated bet on American technology companies wrapped in an index fund label. And here's the counterintuitive part about that. Those S&P 500 companies do earn revenue globally. Apple sells iPhones in Japan, McDonald's operates in 100 countries, but revenue diversification is not the same as investment diversification. When US markets fell sharply in 2022 due to Federal Reserve policy changes, Apple dropped regardless of how many iPhones it sold in Tokyo. The stock is priced in US market dynamics, not Japanese ones. Owning international stocks in the 3-fund portfolio is exposure to foreign economic cycles, foreign currencies, and foreign valuations, not just where the revenue comes from. Here's the part that every S&P 500 advocate either doesn't know or quietly avoids. From January 1st, 2000 to December 31st, 2009, a full decade, the S&P 500 returned a negative 9.1% in total nominal returns. After adjusting for inflation, an investor lost roughly 24% of their purchasing power. $1 million became $760,000 in real terms, not because of a bad stock pick, because of a decade-long stretch where American large-cap growth companies simply went nowhere. During that same decade, a globally diversified portfolio with international stocks and bonds generated annualized returns around 6 to 7%. That $1 million grew to roughly 1.8 to 1.9 million. The question isn't whether the S&P 500 has outperformed more recently. It has. The question is, what are you willing to bet on and for how long? Someone who retired in 2000 with $1 million in 100% S&P 500 and withdrew 4% per year would have been in serious trouble by the end of that decade. Someone with a globally diversified portfolio was fine. This is what the 3-fund portfolio is actually for, not to beat the S&P 500, to survive the decades when the S&P 500 doesn't deliver. Here's the framework. The right choice depends on 2 things: your time horizon and whether you can actually stay invested during a 40% drawdown without selling. Scenario 1. You're under 40 and your money isn't needed for 25 plus years. The math is on the S&P 500 side. You have time to absorb the lost decade. You're adding money every month, which means market crashes actually help you. You buy more shares at lower prices. The bond allocation in the 3-fund portfolio is a drag on returns you don't need yet. The honest answer for a 28-year-old with a 35-year runway, the S&P 500 or the broader total US stock market fund is a defensible choice. The 3-fund portfolio is also fine, but you're paying a complexity and return premium that doesn't have a strong case at this age. Scenario 2. You're 40 to 50 and your portfolio is starting to feel serious. This is where the conversation changes. You might have $300,000 to $700,000 accumulating. A 35% drawdown on that balance isn't an abstract percentage anymore. It's a real dollar amount that feels like a gut punch. At this stage, the 3-fund portfolio's smoother volatility profile starts earning its keep, not just mathematically, but behaviorally. If the presence of bonds and international stocks means you stay invested during the 2008 equivalent instead of selling in panic, the 3-fund portfolio outperforms the S&P 500 in practice, even if it trails it on paper. Scenario 3. You're within 10 to 15 years of retirement. This is the clearest case for the 3-fund portfolio. The academic term for the risk you face is sequence of returns risk. A bad market year right before or right after you start drawing down your portfolio can permanently damage your financial plan, even if the long run average return is fine. The bond component in the 3-fund isn't dragging your returns at this stage. It's providing a buffer you can draw from during a crash instead of selling equities at the bottom. Think of it this way: if you retire in the middle of a lost decade, which you cannot predict, and you're 100% S&P 500, you are forced to sell beaten down shares every every month to fund your life. Your portfolio may never recover its structural integrity. If you have a 20% bond allocation, you spend from that during the storm and let the equities ride. The pause moment. Now, before moving on, if you have more than 10 years of money in a single index fund and you've never actually asked yourself what you would do in a 40% drawdown, pause this video and think about that for 30 seconds. Not what does the math say, what would you actually do? Because the research on retail investors' behavior is clear. The average investor significantly underperforms the funds they own because of bad timing decisions during market crashes. The best portfolio is not the one that theoretically returns the most, it's the one you actually hold. I want to say something that might be uncomfortable coming from a video that just spent 6 minutes walking through the returns data. The case for adding international stocks is weaker right now on a pure performance basis than almost any point in the last 50 years. International developed markets have underperformed US equities for a long stretch. Adding VXUS to your portfolio over the last decade was, in terms of raw returns, a drag. That's true and it is worth saying, but here's the reframe worth hearing. The reason international underperformed has almost nothing to do with the underlying businesses. It has almost everything to do with valuation expansion. Investors paying higher and higher multiples for US companies, particularly technology. Earnings growth between US and international large caps over that same period was actually quite similar. What that means, the current valuation gap between the S&P 500 and international markets is near historic extremes. The S&P 500 trades at roughly 22 to 24 times forward earnings. International developed markets trade at 13 to 15 times. Betting entirely on the S&P 500 from here is in part a bet that investors will continue to pay an expanding premium for US companies relative to international ones. That's possible, it's also not guaranteed. On the bond side, as recently as 2020 and 2021, the case against bonds in a portfolio was genuinely strong. Near zero interest rates meant the bond sleeve in a 3-fund portfolio earned almost nothing and provided very little cushion. People who cut bonds out of their allocation over that period weren't being reckless, the math supported it. That has changed, with the 10-year treasury yielding around 4% to 4.5% as of 2025 and 2026. Bonds are once again providing meaningful income. The opportunity cost of holding a moderate bond allocation has dropped significantly. For anyone over 45, this matters. The honest picture, the case against the 3-fund portfolio was strongest in 2020 and 2021. In 2025 and 2026, with bonds yielding more and international valuations sitting at historic discounts, the 3-fund portfolio has a better argument than it has in years. Here are the 3 mistakes that destroyed both approaches in order of cost. Mistake 1. Thinking you need both. One of the most common portfolio errors is owning both an S&P 500 fund and a total US stock market fund, maybe via your own VTI, thinking they add diversification. They don't. The S&P 500 makes up roughly 80 to 85% of the total US market by weight. You're not diversifying, you're doubling down on the same top 500 companies and adding a little extra exposure to mid and small caps that barely move the needle. If you want domestic coverage, pick one, either the S&P 500 or the total market, not both. Mistake 2. Putting bonds in the wrong account. This one costs real money and it's invisible until tax time. Bond funds generate regular income distributions, interest payments, and in a taxable brokerage account, that income is taxed at your ordinary income rate, not the lower capital gains rate. For a high earner in the 32% federal bracket, holding a large bond allocation in a taxable account instead of a tax-advantaged IRA or 401k can cost 0.3% to 0.5% of your portfolio value per year in unnecessary taxes. Over 25 years on a growing portfolio, that number compounds into something painful. The rule: keep bonds in your IRA or 401k. Keep stocks, especially international stocks, which come with a foreign tax credit, in your taxable brokerage. Mistake 3. The cost of deciding nothing. Here's the real gut punch. Neither the S&P 500 debate nor the international stocks debate matters nearly as much as the money currently sitting in cash. In a target date fund with a 0.6% expense ratio, or in a company 401k default fund that hasn't been reviewed in 3 years. The compounding math on the expense ratio difference alone is significant. A $100,000 portfolio growing at 9% with a 0.05% fee reaches roughly $1.69 million in 30 years. The same portfolio with a 0.6% fee reaches $1.36 million. That's a $330,000 difference, and you'd never notice it year to year. The most expensive mistake in this entire video isn't choosing the 3-fund portfolio over the S&P 500, it's choosing neither and leaving money in something worse than both while the debate drags on. Here's the honest answer to this question. For most people, most of the time, the 3-fund portfolio is the better default, not because it returns more, it doesn't, at least not in the S&P 500's best decades, but because most people are not in the phase of their investing life where they can emotionally and financially absorb a 50% 50% drawdown, because most people are less than 15 years from needing their money for something significant, and because the research consistently shows that the portfolio you'll actually hold through a crash outperforms the one you won't. Here's the framework. If you're under 40 with a 25 plus year time horizon and genuinely high risk tolerance, the S&P 500 or total US market fund is a defensible choice. The return upside is real, the time horizon absorbs the bad decades, and simplicity is genuine value. Just don't confuse "it's worked for 15 years" with "it will always work." If you're 40 to 55 and your portfolio represents real, hard to replace savings, the 3-fund portfolio smoother ride starts earning its keep. Consider a modest bond allocation, even 10 to 15%, as behavioral insurance. The return difference per year is small. The difference in your stability to hold through a crash is not. If you're within 10 to 15 years of retirement, the 3-fund portfolio is not optional. The bond sleeve is a spending buffer, not a return drag. Sequence of returns risk is real, and it doesn't care about your long-run average. The swing factor most people ignore is your human capital. If your job is stable, your income is predictable, and you could survive the salary gap if needed, you can lean towards more equity. If your income is variable, your job is in a volatile industry, or you have dependents who need predictable support, your financial situation is already risky, and your portfolio should be a cushion, not a leveraged bet. One final thought. The international stocks debate is genuinely unsettled. Nobody knows whether the next decade looks like the last one. What the research does show is that starting valuations matter, and international stocks are entering this decade at historically low valuations relative to US equities. The people most confident that international stocks are dead money are usually the people who've only seen 1 decade of data. The 3-fund portfolio doesn't require you to believe international will outperform, it only requires you to believe you don't know for certain that it won't. This content is for general educational purposes only. It's not personalized financial investment, tax, or legal advice. I do not know your full situation. Use this as a framework, then plug in your own numbers, and if you're making a decision with real stakes, talk to a CFP who can look at your whole picture. All investing involves risk. Past performance doesn't guarantee future results. If you've decided on some version of index fund investing, the next question is where to hold it, because the tax rules for a Roth IRA, a 401k, and a regular brokerage account are completely different, and putting the wrong fund in the wrong account costs thousands of dollars over time. That's the next video. If this helps you think through the decision, subscribe. We cover one financial decision per video, no fluff.